Hi, Lenore here, and we're going to go over exercise 2-9. It's called Transactions and T Accounts, and it's on page 86. Now I'm going to do these out of order. I'm going to do B first, show it to you in T accounts, and then later I'll do A, show it to you in a 2-column journal, and then we'll answer the last question. So these are the transactions, 1 through 4, and these are the T accounts that the authors have asked us to create: cash, supplies, accounts receivable, accounts payable, fees earned. So cash, supplies, and accounts receivable are all assets. Accounts payable is a liability, and fees earned, that is revenue. Okay, so let's start. Billed customers for fees earned, $73,900. Now here are the hints. Customers, that means that the relationship is between the corporation and a customer. So if there's no cash, and there isn't, billed customers, then that would go into accounts receivable. Fees earned, of course, that's a revenue. So billed customers, we increase assets with a debit. So we're going to put $73,900 here, and we increase revenue with a credit. So here we have an increase with a debit and an increase with a credit. So that's number 1. And I'll put the 1 over here and the 1 over here. I believe your problem says to put it on the right-hand side, but we'll just do it like that. So that's number 1. The second one, purchase supplies on account. Supplies, that's an asset. And again, it's on account, no cash involved. If the relationship is between the corporation and a vendor or a creditor, right, someone who sells supplies to the company, we're going to use accounts payable, because that's the relationship between a corporation and a vendor. So we're going to increase supplies with a debit, 1960, and I'll put a little 2 over here. And then we're going to increase accounts payable, because now we've gone from owing $0 to owing $1,960. So we increase that with a credit. And again, we have a debit, we have a credit, we're balanced. Now number 3, received cash. That's your hint, received cash. That means cash came in. That would increase cash. From customers on account. Now, customers on account, the relationship is between the corporation and the customers. So that's going to involve accounts receivable. So what that means is that of these original IOUs from the customers, $73,900, $62,770 have paid. So let's go ahead and increase cash for $62,770. That's transaction number 3. And we're now going to decrease accounts receivable because our customers have paid us. Okay. So again, increase to cash because we received cash, decrease to accounts receivable because the cash is from customers on account. Now number 4, paid creditors on account. Again, the hint, creditors on account indicates accounts payable. Paid means that cash goes out. When we pay or have paid, cash goes out. So when cash goes out, we decrease cash, and we decrease cash with a credit. So I'm going to put 820 right there and label that number 4. And we're actually reducing the amount that we owe this vendor. So when we reduce or decrease, it's going to be a debit for accounts payable. So there we go. We've got all our transactions. And let me put number 4 right here. Now, I'm going to show you how to foot the accounts. That is what it's called, footing. And that means we're just going to determine what is the balance at the end of these transactions. So cash increases with a debit and decreases with a credit. Therefore, the ending balance is a debit. Notice it's on the debit side of $61,950. Supplies, we didn't have any other transactions but the one increase. So that balance is going to be $1,960. Accounts receivable had an increase of $73,900 and a decrease of $62,770. So that will leave us a balance of $11,130, and again, it's on the decrease side. Accounts payable, that's a liability, so it increases with a credit. So here's the increase, and then decreases with the debit. So it has a balance of, a credit balance actually, of $1,140 because it increases with a credit. And now we have fees earned, and we only had one transaction. So that balance is on the credit side, $73,900. So let's make certain that our debits equal our credits. So I'm going to type that here because we have to do the same thing. Debits equal credits. Okay, so let's add up all our debits over here. Cash plus supplies and accounts receivable. So those are our debits, $75,040. Maybe it would help if I highlight these, or let's make them a different color. Let's make them green. Okay, so that's the green balance. Now our credits, we have two, accounts payable and fees earned. So let's make those, what color should we make those? Let's make those red. So those are our credits, and our credits equal $75,040. So I'll put a, whoops, let me go back, put an equal sign there. So our debits equal our credits. We also have to make certain that our assets equal our liabilities plus equity less dividends plus revenue less expenses. Now remember, this is the extended equation. Liabilities plus stockholders' equity less dividends plus revenue less expenses. That has to equal. So let's check that out. We have assets of cash plus supplies plus accounts receivable. So again, same number. Now we have liabilities, which are 1140, and we have revenue, which is 73990. So we'll add these two together. And now we have assets. I think I said that was green. Oop, I shouldn't do that because that's going to suggest that our debits are the same as our assets, and that's not true. It's true in this problem, but it's not true generally. And let's put this one in blue. So our debits equal our credits, and our assets equal our liabilities and revenue. So we've managed to balance or to keep both balls in the air, juggling, and that's what we do in accounting. So with that said, Lenore out.